This is our first time doing this on a call where we're going to be offering $1,400 in perks for anyone that's on the call today. The first one is going to be $700 credit, and what he's going to do is $700 credit towards an appraisal. But when you get an appraisal, typically you're going to have to pay for it, and it's going to be 500 to 700 typically, but he'll pay up to $500 towards that, and it'll be part of your closing costs. And then Kimberly and I, so our team, we're Living CA Realty is the team, and we're going to cover up to $700 towards a home warranty, which is, I think, really important. If we can't get the seller to pay for it, then we're going to cough up the $700, and that'll help cover you for that first year after you get the keys.
Everyone has different reasons to own a home. We all come with our own reasons, our own whys, but we find there's a few that transcend across all people. Number one is equity. It's the opportunity to build that over time. When you first buy a house, what you owe versus what the home is worth is the same. But what you hope is that what you owe goes down and the value of the home goes up. And the bigger that divide, the more equity you have in the home. So we're hoping that as you pay off the home is appreciating, it's growing in value. So again, that divide gets bigger and bigger, which means more money in your pocket. So the hope is as that divide gets larger and larger, if you decide to sell, you can take that money and either pocket it as profit or use it towards another home. The third thing we have on here is tax benefits. Now, I am not a CPA, so I'm not going to go into this heavily, but we do have, I believe, 1 or 2 times a year where we have a CPA on, and we do go over the tax benefits for you. So that's a good one to jump on. But there are lots of different ways that you can finagle things with Uncle Sam to put more money in your pocket when you are a homeowner. And then we have upgrades. Now, whether you're renting, living with friends, or you own your own home, you can always change your environment. You can put up wallpaper, you can paint. But when you're renting, sometimes those things can actually cost you money when your landlord's like, hey, I'm going to take this paint job out of your deposit. But when you own your own home, hopefully when it's time to sell your home, those things are going to add to the value. And you can do them in a rental. You can't take down walls. You can't add on rooms, but in your own home, you can do that. And if they're done well, it can add to the value of the home. Be sure to watch those YouTube videos really thoroughly before you get to work. And then lastly is investment. I talked about this before. You can take that money and you can use it towards other properties, or you can take that property, keep it, and use it as a rental. There's just lots of different ways that a home can be an investment for you. These are the top 5 reasons that a lot of people do share. When you get ready to purchase a home, it might be today, you might think it's in 6 months. There are a few things that you want to do first. Number one is you want to build your team. Typically, that team, once you get to the closing line, it's going to be a lot of different people. But in the beginning, it's really important to have a realtor that you trust and a lender that you trust. Hopefully, we can be that for you. If not, you really want to make sure that you've established that a realtor you trust and a lender that you trust. They're going to work together. And then you want to really understand what your credit score is. So there are different ways that you can look online to check your credit score. Make sure you understand what's going into that so that you can change it if need be. Number 3 is boost your savings. Not only is it important to have money going in, it's important to have a cushion. If anything breaks right when you move in, you have some savings to help you get through that. And then number 4 is know your numbers. A few numbers in the process. One is your interest rate, what your income is, your FICO score, all of those things. And if you're wondering, like, well, what numbers do I need? That's where your lender's going to come and he's going to really break that down for you so that you understand what you need to know. And if there's anything that you need to change, he'll help you do that. So those numbers are important for a lender and they know them inside and out because you need them for a pre-approval. And a lot of people get nervous about getting a pre-approval because the one thing I hear all the time is I don't want anyone to run my credit because we've heard over time that if someone runs your credit score drops. People are very afraid of getting their credit run. There's a lot of things you can do without having to do a full credit run. You really do need to have that pre-approval. It's the same as going Black Friday shopping and not having a credit card or cash on you. You're going to find that you're not going to be ready because you don't have your pre-approval and that home is going to be gone. So it's really important to meet with your lender, find out what that pre-approval number is before you start searching, before you find something that you're going to miss because you're not ready, or if you're searching too high or too low in your budget. So you need to know what your budget is, how much money you can borrow from the bank, and how much you feel comfortable borrowing. The bank may say, hey, you're approved for $1 million. And then you look at that mortgage payment and you say, oh, I cannot pay this and feel comfortable. So depending on what the bank gives you, you might want to spend less. So Andrew's going to talk a little bit about that and lead you through the process of pre-approval.
Here is a list of documents needed for the pre-approval. A pre-approval is when a loan officer like myself would review some documents from you just to confirm what you would qualify. So some of the documents would include your driver's license and your social. We would need, for W-2 earners, we would need 30 days worth of paychecks. If you are biweekly, it'd be 2 paychecks. If you're monthly, then just one. If you're weekly, we would need 4 pay stubs. For self-employed borrowers, we would need your past 2 years tax returns. All right. And then for those who do receive additional income, child support, whatever the case may be, these are all things that we would be able to use to add to your income to ensure that you're qualifying appropriately. And then lastly, the last part of the pre-approval would just be to confirm the assets, right? Because like with any home purchase, you would need money for your down payment and closing costs. And the bank would want to just ensure that the money being used for the down payment or closing costs is verifiable. So to do this, I just check your last 2 months of bank statements, or for those of you that have a retirement account, if you receive it on a quarterly basis, I would just need to take a look at that as well. Once I have all these documents, I can review and determine how much you would qualify. I wanted to touch on 3 common types of loan programs for people buying their first home or any home. The first one being the FHA loan. So this is a very common loan program for first-time home buyers for a couple of reasons. So this does come with a low down payment requirement of 3.5% of the purchase price. All right. With this program, the payment is fixed. It could also be adjustable if that's something you might be interested in. It depends on your preference. With the FHA loan, the private mortgage insurance, known as PMI, is not cancelable for 11 years. So you're stuck with that for 11 years. The FHA loan is flexible in terms of credit score. All you need is a 580 and above, and then you're eligible. Okay. The next one is the conventional loan, which is another common loan program. This one is also fixed. It could also be adjustable as well if that's something you're interested in. The private mortgage insurance is cancelable once you reach 20% equity. So just depending on how much you put down and how long you've had your home, once you reach that 20% equity mark, you can call your mortgage provider to request that private mortgage insurance be removed from your monthly payment. With the conventional loan, it does require a slightly higher FICO score of 620, which is a big difference between conventional and FHA loan programs. For conventional financing, you can put as low as 3 or 5% of the purchase price for your down payment. Next is the VA loan. So the VA loan is a loan specifically for active duty and veterans and their families. There's no private mortgage insurance. The biggest thing is that there's no down payment required, which is a big help for those who don't have the means for a down payment. With the VA loan, the payment is much more affordable because the rate is lower. It's comparable to an FHA loan, and there's no mortgage insurance, making that mortgage payment much more affordable.
Perfect. And then could you also explain real quick for PMI, what exactly is PMI or private mortgage insurance?
Yeah, absolutely.
Because
So
everyone always asks me after, what exactly is that? Do I benefit from it? A little bit about that.
yeah, absolutely. So private mortgage insurance is more so for the bank whenever someone who's purchasing a home puts less than 20% down. So it's extra insurance tacked on by the bank to help protect their investment. Okay, so it's not necessarily beneficial for you. So it's always great to try and remove it as quickly as possible.
This is something that was put into play because of 2008. If we're all waiting for 2008 to happen again, this is one reason why I personally don't think it'll happen again.
Now, there are also some buyer programs available for those interested in having their down payment covered by other entities. For example, the first one that you see here, the Cal HFA FHA program, is a FHA insured loan where the state of California will cover your down payment at 3.5%. The money that's used to cover your down payment, you pay back in the form of a second loan, either when you refinance or when you pay off your property. There are a plethora of different down payment assistance programs out there, just depending on what your income is, what your credit score is, and that will determine what you qualify for.
So once you get that pre-approval locked in, there's some things that you don't want to mess with financially in your life. And you may think they're little things that won't make a big difference, but because of how things go on the back end, they make a huge difference and you can lose that home that you have your heart set on. So number one, Proceed with caution if you change jobs, become self-employed, or quit your job. They have given you that pre-approval based off the income and the job that you have. So if you go from being a nurse at one healthcare company to a nurse at a different healthcare company, that might be okay because you're in the same field. But if you go from being a nurse to coffee shop owner, that's a very big change. So you might not be able to qualify, or things are going to be different. So always talk to your lender if this is something that you think is coming down the pipe. Number two, don't buy a new car. Maybe you decide it's time to get a home, and this is the time because you've got a new job, you're making a lot of money, maybe you got a big bonus, and you're like, hey, we're going to buy the house and the car. It can affect your numbers. So don't buy that car. There's a saying, don't buy a new car unless you want to be living in it. So be very careful with buying a new car. Don't use your credit cards excessively or let your accounts fall behind. Now, do what you've been doing. If you spend $5,000 on your credit card every month and you pay it off every month, that's fine. Keep doing what you're doing. But if you spend 500 a month and all of a sudden you start spending 5,000, it's going to change things. So be very careful with that. Number four, don't spend money you have set aside for closing. You've saved all that money, you listened to us, you put all that money aside, and then something comes up. Maybe one of your friends needs some help, or you find that couch you've been looking at and you decide, oh, I can spend that money. Don't do that. Keep everything just as it was when you got that pre-approval. Don't omit debts or liabilities from your loan application. Maybe there's something in your financial past that you're a little embarrassed about, like, oh, I got this card, I let it fall behind. It was a crazy time. When they run the numbers again, they're going to find it and it might affect things. So it's like going to your doctor. You just have to be upfront. Just tell your lender everything so they can make sure to put all the checks in when they need to go. Number six, don't buy furniture or appliances until you own your new home. So you finally find that house, but it doesn't come with a fridge. So you're shopping, you find the best fridge. Hey, we're going to go ahead and buy it now. We're already in escrow. It's not a big deal. It is a big deal. Don't do anything without talking to your lender. I hope the point is coming through on these rules. Don't change anything. Don't apply for new lines. Don't make large deposits. This is really important because a lot of people get gifts from family members for down payments. And that's great if you can do that, but talk to your lender to make sure that it can be used. Don't let them wire that money into your account. Don't change your bank accounts, and don't co-sign on a loan for anyone for any reason. I think it's been made very clear with these 10 rules, whatever your financials are going into that approval, keep them until you have keys in your hand. Don't change anything.
All right. And then Kimberly, if you want to jump into this one.
Yes. So one of the big questions we get is, how do I know when I'm ready financially? How much do I need? And again, that varies from person to person, how much risk you want to take, but there are a couple of numbers that are going to be important. Number one is your down payment. And I also think there's a really big myth that circulates around down payment. A lot of people think that you need 20% to purchase a home. Now, it's beneficial to have 20%, but it's not necessary. In fact, the majority of the homes purchases that we deal with are less than 20%. Most people that we're selling homes to are not putting 20% or more. They're doing under 20%. Typically, you're looking at 3.5 to 20%. Most common you see there's 5 to 10. So although it can be helpful, you don't need the full 20%. Once you get into escrow, there's going to be a few things that are going to come up that you're going to need to spend money on. And one is an inspection. We're going to help you find a home inspector. They're going to come into the home, take a look from the roof down, and let you know what's wrong with the property, what might fall apart in the future, some things that you might want to get repaired now, or some things that you might want to have looked at by a different professional. And that cost is going to be between $300 and $600. So you're going to need to pay that out of pocket. If you're getting a loan, if you're paying cash, lucky you, you don't have an appraisal. But if you're getting a loan from the bank, you are going to need an appraisal. That appraisal is going to be a neutral third party. They're going to come in and say, hey, we think the home is worth X amount. So if you're spending $800,000 and the bank comes in and they think that the property is only worth 700, they're not going to give you the money that you need. Someone's going to have to cover that difference. But if you're spending $800,000 and the bank comes in and they say, hey, it's worth more than that, then you just made some money. So again, that can be between $500 and $700. And then you're going to need closing costs. So there are a lot of people involved in a transaction, up to 100 people, and they're all just like you and me. They're working their jobs, they get their paycheck, so they have to get paid, and there's going to be different fees. You can estimate those fees are going to be around 2.5% of the cost of the property. So those are fees that you're going to need to have on hand because it's part of your closing costs. And then you need to pay your realtor. It's changed a little bit. But just so you know that if we're working for buyers, David and myself, we do not get an hourly paycheck. We don't get paid by the hour. We don't get a paycheck every 2 weeks. If we're driving you around all day long, we don't have a company card that's paying for that gas. We're like independent contractors. We are business owners and we're paid per job. We don't get a paycheck. We only receive compensation if we get you to the finish line, to the close. If we work with you for 6 months and then your great Aunt Matilda died in New York and you get her condo and you're going to move to Manhattan, we're super happy for you, but we don't make any money. So, because of that, we typically ask you to sign a buyer broker agreement in the beginning where we outline our fees and how those are charged at closing, just so that it's very clear and that we're agreeing to work with each other. Like we're saying, hey, Jane Doe, I really want to work with you. I have time in my schedule to work with you. And Jane, are you committing to work with me? We're going to be working together. And so that written agreement is now actually required. In January of this year in California, it's now actually a law that we do have to have that agreement signed before we start looking at homes. So that agreement is going to clearly state what I'm doing for you as a buyer's agent and the services I'm going to provide, how long that agreement lasts. We can only do it up to 3 months. We can keep renewing it, but if we're really working hard, it should only take 3 months to find your home, and how much we charge. That's going to be very clear in the contract, how it's calculated. We use the word negotiable because we are business owners. So if you've ever looked for a service, maybe you're looking to get a haircut or a dog walker, different people charge different things and we can charge different amounts. So that's where negotiable comes into play. And that fee can't change. It can go down if we need to negotiate, but it can't go up. And then virtual tours and in person. So you might wonder, well, if we're just doing a Zoom call and you're showing me, I live in Ohio and I want to see this property in Long Beach. I can't be there. Can you just show me on Zoom? We still need that agreement to be signed. However, if you're just walking down the street and you see an open house sign, you can walk into that open house. You don't need an agreement to go into open houses. However, when it comes to that fee, we are going to try our darndest to get the seller to pay that fee for you. Up until August, that's pretty much how it went. Some things changed. So now sellers can give a little bit of pushback, but that's where we shine. We're going to negotiate so that fee is covered by the seller. We're also going to try to get some other fees covered by the seller. If there's any repairs that need to be done, we take a look and that air conditioner is not working. We're going to say, hey, Mr. Seller, we're going to need some money for that air conditioner for you to fix it for us. Part of our job is to help negotiate those fees, maybe get you some closing costs, get you some repairs, and make sure that you're walking away with more money in your pocket.
All right, thank you.
Yeah. You want to talk a little bit about a new build?
I would love to talk about new builds. So if
Okay.
anyone is interested in new builds out there, and new build is just a new building that it's being built. So if you see out there like KB Homes or Pinnacle, there's a lot of different ones. But that would be a new build, and everyone's like, "Oh my God, new build! It's gonna be nothing's gonna be wrong with it. It'll be perfect." Okay, not always the case. So what I would say when you go to these new builds, if you want to pop in there, let an agent know first. Hopefully you want to go with us and we can go with you because if you go there on your own, they're going to say, "Oh, just sign here and we'll let you in." But no one ever reads the fine print on when you sign that you're saying, "No one can help me. I'm going to go with this person that works for KB Homes." The problem with that is the person that works for that company, they get paid a salary by that company and that's the person representing you. Versus in our situation where we would represent you, I don't work for them, I work for you guys. So I'm going to fight for you guys to get whatever. Recently, I had a home that I sold and we were able to negotiate. I have to do my job. And part of it was to say, oh, my client doesn't care about the solar, knowing that it already had solar on it and they couldn't remove it. So I was able to get $18,000 to pay for the solar because my client, like, let's just say they didn't want it. So I ended up getting them to drop the price or to reimburse us in a credit for $18,000. That's one little example of something that I did that pay for myself. And then also, there's a lot of things that are wrong with those properties, and that's okay. But we want to get an inspector to come out there and fix them. We go to bat for you. The good thing is at the end, you have a house that works and you have a dishwasher that's connected, which was one of the issues with the one that I sold. But it all worked out and everything was good. So with that, go with us. We'd happy to go with you guys to the new build. House hunting checklist. Always scout out the neighborhood in person. I have clients that want to look at a different areas and yeah, no problem. Let's go look there. Maybe drive around that area at night, drive around during the day. Let's say, for example, you walk your dog at 11 o'clock at night. That's great. But do you feel comfortable walking your dog at 11 o'clock at night? Or I get home from work at 7 p.m. There's parts in Long Beach where if you get home at 7 p.m. and you don't have a parking spot or garage, you might not find a spot for an hour or two. So it's something you want to pay attention to, or you get up in the morning and, how is it walking around in the morning, that kind of thing. So you want to make sure that you pay attention day and night, kind of walk around and get a feel for the neighborhood, make sure you feel comfortable there. You also want to consider nearby freeway, shopping activities. If you're by a golf course, that's great. But you drive, but you're by a freeway, that could be good, but how close are you to that freeway? Are you under the underpass? Might be a little loud. And is that something that are you a light sleeper? You might not want to live there or on busy streets like that. So something to pay attention to. Noise is one. Freeways, cars, airplanes. I just sold a house 2 weeks ago that was at Long Beach Airport, and the plane comes down right over the house. And they were perfectly fine with it, but I just made sure to point it out. So just something to be aware of. You could soundproof that kind of stuff, but is it completely silent? No, you can still hear it. So you want to pay attention to that kind of thing. Also, pay attention to schools. If you have kids or in the future you want to have kids, maybe pay attention to what the ratings of those schools are. Also, if you don't have kids and you get annoyed by them, maybe that high-pitched scream some kids have, you're going to have to listen to that every day around lunchtime and after lunch. Just make sure you're aware of that. And if you're okay with that, then great. Also, back to using your senses, smell. When Kimberly and I go look at places, we'll point these out. For example, if you live in Chino area, so you just want to be aware of that thing. And you kind of get used to it after a while, which sounds weird. Yeah, be aware of stuff like that. Also, electricity. You want to make everything areas that we mainly focus in. I know Kimberly has sold land in certain areas where maybe they don't have electricity, but things you want to pay attention to. Is it hooked up to the electric system? Do you need to have your own solar panels? Is it going to be sewer or septic? I've sold some houses where there's a septic system, and that's something we know ahead of time, and we could fight for different things and making sure they empty it out because you don't want to have a full septic system. That's not fun. But usually in most areas in California, it's going to be on sewer. And if it's part of an HOA, a lot of people think, oh, it's a single family home. There's no homeowners association. But there's a lot of places that do have. If it's like more of a planned community, if there's a tract of 8 homes and they all look the same, probably it's going to be some kind of homeowners association. A lot of times it's a low amount, but just something to pay attention to. Different service providers, I can go down a long list of these. Whenever you guys need someone, whether it's for this purchase or, you're doing something to your house. All right, this is my favorite slide. This is the journey to home ownership. This is where we talk about the process from start to finish. What you want to do is build your team. So you have people on your call right now that can be on your team. You want to have someone you could trust, team you could trust. You could check that off. We're good to go. We also have obtain a pre-approval. You want to connect with a lender like Andrew on the call today and get a pre-approval so you know how much you qualify for. Then we'd set you up with a search or not yet. First, we want to sign that agreement. So you would sign an agreement with us so that we know we are representing you and we're ready to go. After that, we would set you up with a search and start sending you properties, sometimes off-market properties when we have the agreement. We go look at houses, maybe we look a few times, maybe you find the first home and you love it. At that point, we would write an offer. We would walk you through the process. Kimberly and I walk you through every page. It's at least 28 pages, a lot of stuff, but that's something that we know like the back of our hand. We can walk you through every step of the way and explain our strategy for you on the way we write the offers. We can nerd out on that for a while, but let's just say we write that offer. In this scenario, maybe there's a counter offer back and forth. There was 2 offers. They countered us. They wanted to clean something up. Great, perfect. Now let's just say we got our offer accepted. So we do this offer acceptance day, really exciting. And at this point, now they're legally bound to you. That seller is legally bound to you at that point. And at that point, you want to wire your earnest money deposits, also known as your EMD. This is between 1 and 3%. I always recommend doing 3% if you can. And this is just part of your normal down payment. You're going to wire this into the escrow account. Escrow is a neutral third party. We have the buyer, seller, and then escrow's in between. They're holding the money. They're making sure we're following that 28-page contract. When you wire your earnest money deposit, that 3% goes into the escrow account, and they hold on to the money until the end. Next step is we have our contingencies. So the three main ones that are going to be your inspection, appraisal, and your loan contingency. So as long as you have these contingencies in place, then your earnest money deposit's safe. Remember, escrow's in the middle, typically right around our area. That money is being held there until the end when everyone's happy. But you're not happy until you remove all contingencies. First, your inspection contingency. This is, I think, the best one because you can get out for really any reason. You could walk around and say, you know what? Kimberly, I didn't like the way the neighbor looked at me. Okay, no problem. Get you out of this contract. Then you get your full earnest money deposit back. And this is also the time to negotiate some things. I know Kimberly brought up earlier the AC didn't work, as an example. You have your inspector that comes out, they look at it top to bottom. Let's just say everything looked pretty good, except for the AC. We offered $800,000 on this house, as an example, and AC doesn't work. That's a problem. So then we would get a specialist to come out and give us a quote. We get an AC person that says, yes, the unit needs to be replaced. It's going to be $12,000 to replace that. Okay, great. Then we go to the seller. This is when we play hardball because remember, they're legally bound to us at this point. And we say, you know what? We wrote an offer on this home. We offered 800,000, but it's not worth that because we offered 800,000 for a house that has an AC because it's getting really hot outside. And that's not worth it to us. But it's okay. We'll continue to move forward, but we want you to drop the price $12,000 because we got to pay for that. Or we want you to give us a credit for $12,000 because now we got to buy a new AC. It's going to be 100 degrees next week, so we want to make sure that we're good there. So that's something that we would go back and forth. Just know that they always have the option in California to say no, because in California, all homes are as is, so they can just say, no, sorry, we'll put it back on the market. It doesn't mean you lose your money. If they say no and you decide you want to back out, then you get your money back and then it would go back on the market. Or you could meet somewhere in the middle. It's okay. So you give us $6,000 credit, we'll pay 6,000, we'll call it easy, or meet somewhere in between. So that's an example of what we could do. But let's say in this scenario, they said, sure, we'll give you $12,000 for that. Okay, great, we're happy. Let's remove that contingency. We have two more left, our appraisal and loan. The appraisal is important. Kimberly talked about it. This is something the lender requires if you are getting a loan on the property. Let's say $800,000, the appraiser comes out, they give their opinion of value. They say it's worth 810. Great. That means you have $10,000 in equity already and you just bought the home. So that's a good day. It just means you have some equity already. It could appraise at value. It appraises at 800,000. Great, perfect. You're going to get the loan for the full amount you want. You're happy. It also can go the other way, where it appraises for 790. That's not the end of the world. It appraises at 790. Then our job is to go to bat again and say, you know what? We offered you 800,000 for this house because we thought it was worth that much, but clearly it's not because we had an appraiser comes out. They said it's worth 790. We want you to drop the price by 10,000. Okay, then usually the seller will drop that, but or meet you somewhere in the middle. They don't have to though. Keep in mind, if they say no, you could just leave and get your money back. You could meet somewhere in the middle, or you could say, you know what, I love this home so much. There was 15 other offers on the home. We just want this home. We like the swing in the front yard or whatever it is. Then you can adjust your loan a little bit and pay the difference. But typically that doesn't happen. I think I've only had that happen once. But typically it appraises at value or more, which is great. And then the last contingency is going to be your loan contingency. This is in place until you actually get the loan approved and they have the money. The lender is going to be a big part of this. They're going to say, yes, they're good to go. We can remove that contingency. Times where I've seen where maybe this could be an issue is like, let's say it's that last 7 days right before you close. If you lost your job, oh, I'm not going to listen to Kimberly and David. I'm going to buy that new Lamborghini. Okay, you probably don't want to buy it because that'll throw things off. But typically that's all fine. That is your one way out of there. So let's say right before that, you lose your job before you remove that contingency. You're not going to get a loan. Okay, you back out, you get your full earnest money deposit back. So those are your three main ones, and then those protect your earnest money deposit because that's a good sum of money. You want to make sure you protect it. All right. So we remove those contingencies. We're good. We sign loan docs at that point. You sign all those in person, then move forward and hand you keys to your home. You can look online for Google, Zillow. You can see reviews on myself and Kimberly. Make sure you keep in touch with us. We do a lot of calls throughout the year. Like we have CPAs on, talk about tax benefits, home inspectors on, all that fun stuff. If you have any questions, you could schedule a meeting with us. Let me give you that info. If anyone has their phone with them, you could scan with your phone, or if you have Instagram, you could also just type that in for both of us. Make sure you get Andrew as well. We share a lot of stuff, mostly real estate related, but we're also people too. So you'll see a little bit about us personally. This is also a good page to take a photo of or take a screenshot of so you have all our phone number and everything. In case someone has to be out by 10, I want to make sure we jump to the next slide because this is a really good one. This is, again, the first time we're doing this. So make sure you scan this. If you have your phone, take your camera function, go over the QR code, and make sure you scan this. It's going to ask you a few different questions. You can also go to livingcalocal.com and it'll go to the same site and you could fill out a couple different things because we don't normally give $700 to everyone, but if you're on the call today, we're going to give you $700 towards that appraisal, or Andrew is, and then Kimberly and I are going to give you $700 towards a home warranty if we can't get the seller to pay for that.
Thank you again for coming. I hope everyone got some good information. Our phone numbers were in that previous slide, so if you need to reach out with any questions, we'd be happy to answer them for you via text or call if you don't want to ask them on the call today.
Yeah, same here. However you guys need help, any questions you have, please feel free to text me, email, call, however you prefer. I'm available.
If anyone does have questions, remember, take a screenshot of this one, and then you guys can follow us, and we're happy to answer any of those. You could send them through email, text, call. We're really easy to, or if you carry a carrier pigeon, if you have one of those, you can also do that too. All right, well, thank you everyone for joining the call today. I know we're 2 minutes later. I know we kind of breezed through it at the end, but we get really excited about this topic and we like to talk about it, if you could tell. Thank you all for joining the call today. I hope you have a lovely Sunday. I know it's going to be a little hot outside, so hope you enjoy it.